All right, cool. So your question was about the swing highs and the swing lows, right? So
Yeah.
just remember, there's a difference between highs and lows. You can still see my screen, right?
Yeah, yeah.
Just remember, there's a difference between highs and lows and swing highs and swing lows. So, like, these are all highs right here, but a swing
Yeah.
high, remember, is that three candle pattern where you have that wick or body that comes up in between those two
Yeah.
candles that swings. It pivots. Like it comes
Yeah.
out like this. Same here. That's a swing low, swing high. So you understand that. I see how you
Yeah.
get
Yeah.
that. But I get what you're getting stuck on. So you're trying to look for what what is more probable, like what kind of swing lows and swing highs you should be looking at, because they're everywhere. If you were to sit
Yeah.
here, and this is what I did when I first started, if you were to sit here and mark out every swing high, the only thing you're going to improve at, it's not you're not going to be improve at trading. The only thing you're going to get good at is how to identify swing highs and swing lows,
Yeah.
which is like the easiest thing to identify. So if I just sat here and I did this all day, this is great, but like at the end of the day, if price comes down and well, maybe on the hourly it's a little more important, but if you did that
Yeah.
like on the 15 minute, if I sat here and marked out every single thing, it's going to get too jumbled. If I sat here and did this over and over and over, and price comes up and takes this high, I'm here to tell you from my own market experience, price does not give a fuck about this high right here. It doesn't give a shit about it. So at the end of the
Yeah.
day, here's what you have to know before you actually figure out which ones. You have to remember one thing right here, and this is the best way. Price trades in ranges.
Yeah.
Price aims to take liquidity, like you know. I know
Yeah.
you know that. And then lastly, price takes internal liquidity and then moves to external. Or
Yeah.
external to internal. Does that make sense? So if you
Yeah.
have these are like the three key rules of price action and how to read like basic liquidity. When you're looking at any kind of liquidity, you need the forefront, you need to know about the ranges. So the best way I describe this is start with the daily. The daily, now
Yeah.
remember, the daily is a big time frame. These candles are thousands of ticks. That's 2,000
Yeah.
points or 8,200 ticks, right? So
Yeah.
it's more significant. Like if we were to move from here up, it doesn't look like it's very far, but it's really fucking far. It just doesn't look that
Yeah.
way because the candles are daily candles. So the daily,
Yeah.
I start off. Usually, I'll mark out the most recent swing high and the most recent swing low, kind of like how I was saying not to do on the lower time frame. I would do that on this one maybe. I might even mark
Yeah.
out this one, which would be previous day low, because it looks like liquidity could come down potentially.
Yeah.
Remember, you're not trying to predict anything, but you want to know when I'm zoomed in here on the 5 minute. I don't see that low unless I fucking go all the way back here and look.
Yeah.
I might not see it if I don't have this line here. I might not see, hey, price is aiming to take out some major daily liquidity here. That's sell side liquidity, right? Same thing
Yeah.
with the upside. So it's just you kind of just want to know if those get taken out. It's not necessarily anything. Not to mention, once you learn about SMTs, I don't know if you have, but once you
No.
do,
No.
okay, well, once you do learn about SMTs, it's good to note that like we're
Yeah.
forming daily SMTs. For instance, right here, we have a daily SMT. The best way I could teach you, just very quickly, don't try to trade this because you're too new to this. But
Yeah.
basically, if you notice, a lot of traders like me will have ES up, which is the S&P 500, with NQ.
Yeah.
I trade NQ. It's the only reason is because we're seeing if price wants to take liquidity on one but not the other. If you notice right here and right here,
Yeah.
these are the same highs, right?
Yeah.
NQ failed to take this high. See that? Failed to take the
Yeah.
high, but ES took the high. That's an SMT. An SMT divergence, that's what it's called. Don't try to trade those. Don't worry too much about those. You don't even have to take notes on them. Just
Yeah.
the forefront, you want to have your highs and lows mapped out. And
Yeah.
so on the daily, like I said, just kind of mark out daily highs and lows. The most recent, you don't need to sit here and mark this one and this one and this one unless we have a crazy sharp move up. But if we have a crazy sharp move up, you're probably going to scale up to a higher time frame anyways because you're going to have to zoom out so much if you're on the 5 minute or the 1 minute. I like to go to the 4 hour as well. I love the 4 hour cycles. So the macro I personally love trading is the 950 to 1010 macro. Macro is basically a range of time, like a time range where price is most likely to be more volatile and move more aggressively, which is good because you want to be in and out of the trade when you want to catch the move and get out. That's when the moves happen. Yeah. This right here, prime example. But this is the 4 hour. The 4 hour, it works synonymously. The 4 hour seems to take, in the 1 hour, take a lot of liquidity. Price almost always goes off daily, 4 hour or 1 hour liquidity. But it usually manipulates 5 minute or 15 minute liquidity first, like a 15 minute swing high before it tanks, or other way around. It usually manipulates those people to stop day traders out to try to, because institutional traders are trading thousands of contracts. They're holding them. They're trying to aim for more significant lows like this maybe. So, because they're trying to make a shit ton of money. So at the end of the day, 4 hour, I like to just kind of look at it and compare it and see what it looks like the most recent 4 hour candle is doing. That I don't really mark out highs and lows on this. I just do that on the daily and the 1 hour. The 4 hour, so like the 950 to 1010 macro, the 950 is the last 10 minutes of the last 4 hour candle closure. So this candle right here today, 950, there's 10 more minutes left on this one. This is gonna be volatile, and then this one, it's the first 10 minutes this one opens. So right when this opens, up to the first 10 minutes that it opens, okay?
Yeah.
So that's what macros are useful for. So then I like to go to the 1 hour. The 1 hour is very useful for finding liquidity as well. So this is probably where you might get confused, because the daily was obvious. The 4 hour, I told you really not to mark too much. But look, we have the daily here. We have all kinds of highs and lows, right?
Yeah.
What I would personally look for, I would probably mark this low out right here, because it's a significant low. It's by itself. It's easy to zone out and say that's it. Like if price comes out and takes it and reverses, you know that, okay, this level right here is what it took. You just need to pay attention as far as just highs and lows. You're just seeing if price takes them, because it's more likely to reverse after it takes it. Price is aiming to take either here, like one of two things is going to happen in the market, right? Price is either going to take this high or this low. And once it does, it's probably going to reverse or take more liquidity. That's the only thing it can do. It can continue or it can reverse. Or retrace. Continue, reverse, retrace. Those are the only three things the market can do. It's not going to trade here forever, like for the rest of NASDAQ history. It's going to take these. It's a fact. So why do I pick this high? Why do I pick this low? I think these are significant because this right here came up. We had a strong move up right here. Very strong move up. Not just like a move right after. Like this right here is just a rebalance or a retracement. It moved down and moved back up. I don't really give a fuck about any of the highs right here at all. This is a high I'm way more concerned with. Like if price comes up and was to take this, I would be anticipating a potential reversal or continuation. Yeah. This one right here, you could say on the hourly could be significant, which it could be because you also have a fair value gap right here. Like potentially, but you're not anticipating anything. But I'd say, like I said earlier, internal and external ranges, right? So the internal range, right, would be something right here. This is an internal range. All of this right here. Okay, but external range would be something like this. Does that make sense? So internal is like what we're currently in. External is... So price at the end of the day usually moves internal to external range liquidity. So, or external internal. So here's how it would work. It would look something, this is hypothetical, mind you. If price came down, took this low, you would want to see how it reacted. If we had a sharp move up after that, and then it like formed some sort of market structure shift, then that's probably a bullish indication, but it would have to probably come up a little bit higher for me. But honestly, I think price would probably be more likely to take something like this just because this is external range liquidity. This is technically external too, but this is more of like an internal range. This is internal. This is more external. I'm actually just going to delete this one right here. So this is internal. This is external. It's good to know both of them. I like to know the most recent major swing high and swing low like this. It just comes with time in the market because I used to just mark out highs and lows. But like let's say before this move happened, if I want to mark this out, I would do this one and this one probably, or this one and this one. So I would say, okay, cool.
Yeah.
Let's say price is right here. I'm looking for it to break below this. This is probably the external range liquidity right here, and this is the internal. This is also the internal. This is the external. So look, what does this tell you right here? Price came, right?
Yeah.
And this is the external range, right? You need to know your external range liquidity because price gives a fuck about external range. If you're in internal range, you're inside of external range liquidity, it's drawing towards buy side or sell side. External every time. So it's internal to external range liquidity moves. It swings that way. So you have your external low, your external high, right? You have your internal high, your internal low that were formed on the hourly, for instance. This is the hourly chart. Now, before I say this, please don't apply this to every time frame. Don't apply this to the 5 minute necessarily, because I promise you right now, if you look back on this on the 5 minute, it like high low, like it gets a lot more confusing and noisy. So the high time frame is the best method for recognizing high time frame liquidity, which is more high probability liquidity. So this right here, high and low, let's say price is right here. What I am anticipating is for it to either take out this high, to take out this FEG right here, or to take out this low. Right? If it takes this low out, I'm seeing if it is going to reverse, or I'm seeing if it's going, because sometimes it'll come down wick real quick and come back up. That's called a turtle soup. It did it right here. So it came up, took out this. This is a small form of liquidity. I'd say it's more so this fair value gap right here. Came up, tapped into it, took out some liquidity, and then came right back down. And then came back up. So it's just a manipulated play. That's more advanced and confusing. Think of it more like it's just internal to external. So that we're in the internal range. And what does it do? It doesn't take out the external, but it draws towards it. And then we have a sharp rejection. And this is a shit ton of hours. This is like a full day or two. We've been sitting here trading down. So that means, at least for right now, price doesn't seem to give a fuck about this. That's what makes this one important. That's what makes this the new external. Because at the end of the day, you're not really zoomed out this much on the hourly chart. That'd be ridiculous, the amount of ticks on that range. So you want to identify what's called your daily ranges. So your daily ranges, like I said, I showed you how to do on the daily chart. The 1 hour, so you're already going to have, the daily chances are you're probably going to have, like the most recent daily high and low, you're probably going to have your external range. But if not, go to the 1 hour and look at it. Do you think you'd have any problem recognizing like this right here? This range right here. Like seeing that this is external.
I don't think so, no.
Yeah, just remember it's the okay, this is another good example. So we have our external high here, our external low somewhere around here, right? Price is trading in the internal range. It has a sharp move down. It comes up and retraces into this FVG right here. It doesn't always have to be this FVG, but for this, what happened this time, came up into this FVG, took out there's an order block right here, took out that order block, and then it traded down. And then it took out external range liquidity. So internal takes out liquidity internally, trades down externally to take out external range. That's the most violent moves is the internal to external. So I would recommend you don't trade external to internal. For instance, price forms this new low right here. We hold above this low. We didn't really take out external range liquidity. We just kept trading down. If we did, it was way over here, but we just kept trading down, right? Because we were just in a bearish trend and it was just sharp moves down. You can see constantly we're just moving down over and over and over, right? So the best way to identify this shit is look right here. So we form this high. You know this is your external high because that's what price. If price took this out, it'd be pretty important. If price took this out, it'd be pretty important. So you don't usually want to trade external and internal. So I'm not trying to trade the move up to this fair value gap or the move up to this fair value gap or the move up to this order block. Why? Because I have no way and no trader will have any fucking idea whether price is going to go here and then drop, whether it's going to go to this order block and then drop, whether it's going to this fair value gap drop, whether it's going to do this and drop, whether it's going to wick this and then come down, take this high, whether it's just going to keep trading up. You have no way of knowing. So what do? You do what the market tells you. So something like this might not necessarily be would have been a perfect trade that I would have caught, but I would have noticed right here, one thing that is really good is these fib retracements. You can make it with these settings right here. So basically, I have it on extend lines right, and then all I have is a 0, a 1, and a 0.5 set. The 0.5 I have red, and I turn off background. It's just my premium and discount zones. So number one confluence, it's the best way to do the best way. Like a great confluence for you to practice right now is after you have identified your external range, is to actually map out your external range like this, so you can have that 50 level. When price usually comes up into here, this is where people are looking to go short. People are looking to go short here or here. They're looking to go short once we come up here. I'm willing to bet you a lot of people came right here because they saw this order block tap. Almost tap, and it looks like a rejection. So a lot of people went short here, placed their stops right here. Well, what conveniently happened right after that? Price came back up and manipulated the shit out of them because they were antsy to enter. Patience pays, brother. So if you are patient, it's going to come up. You already have a great confluence that you're in premium. This is discount. This is premium. If you're going short, you want to be shorting in premium. If you're going long, you want to be longing in discount. You don't want to be going long right here on the external range. If you long right here to take this out, that's it. You're going to have a negative RR, or it might because price doesn't always take it out. Like this range right here, this range, price could have, it didn't. It went right here. It didn't take this out. Price could have easily taken this out. It happens all the time. Look right here. Before this violent move down, we had this. This was the range. Price came up and took this range out. It took it out and then tanked. So my point is, you have no way of knowing what liquidity it will take out. But once it does take out that liquidity, you need to know what it is and then plan an entry after that. So this order block right here, I would see it tapped, rejected. We came back into discount. If you were bullish, you could have taken a long back up into here. That would have been a good low-hanging fruit. But the problem with that is that's internal to internal. You know what I mean? You're just trying to trade up to more internal range liquidity. At the end of the day, don't get tunnel vision. Think of it like this. External range liquidity, you want to place your trade in the internal to get the external. So my point is, like, what I mean when I say that is that I'm trying to take either this high or this low. That's where my take profit is, or it's close to it. It could be a little bit above it if you wanna make it more probable, but because like I said, price doesn't always take it out. Like right here, if I would have traded this range and my TP would have been right here, I would have got stopped out. So I would highly recommend don't always place it at. You can place it at the swing low or at the swing high, depending on if you're bearish or bullish. But don't be afraid to take profits a little bit early. Like if you're only up a little bit, I wouldn't take profits. Let it ride out for a while. Be confident in your trade. But if you're like right here, and then let's say this doesn't take it out and it comes back up right here, just take profits or take your stop and trail it. So drag your stop loss to like not too close, but like maybe here. And then once you see this candle sharp move down, maybe here, you see it trace back up here. Maybe bring it a little bit more down, and guess what? You're only going to lose like $100 or $200. Like seriously, it's not that. That's not any. Because guess what? At the end of the day, you got to realize it's not that you'll make less. It's that you won't make anything because you'll get fucking stopped out if you don't. It would have come here, and then it would have consolidated for a shit ton of time. Your stop, chances are, probably isn't still going to be right here whenever that happens. So you're probably going to have trailed it down to at least break even, which could have been right here maybe. Who knows? Whatever your entry was, you're going to get stopped out. Or if you're trailing it, you're going to get stopped out. So at the end of the day, just always have a stop loss. But I'm kind of going off on a tangent with that. But the main point I want to drill with you is once you identify your swing highs and swing lows, so like major highs and lows like this, not like this or this. The price doesn't really give a fuck about something like this. Because price came up and disrespected the fuck out of it. Price respected this high. It didn't come. It came near it and said, "Okay, I'm gonna dip." That's what happened. Same with this high. Not so much this high. Kind of, but not so much. Not really. I mean, kind of this high, but not really so much. Price didn't really come back up. But maybe something like right here. You know what I mean? So that's how you identify hourly or high time frame external range liquidity and internal range. That's the best way I do it. So I got this with my daily, high and low. So I know my daily range. That's called daily range. This is my hourly high, and swing low, in my opinion, that are most notable. Like if we were to take this out and close above it, that's a bullish market structure shift.
Yeah.
Like a strong close above it, because it could just close right here or right here and it wouldn't mean shit. But if it came up and like closed right here, then I would expect for it to come down a little bit. I would enter off that because that's a great fucking entry. I would see what it's doing though. So it would come up, take out this internal range. But the thing is, if you zoom in more, this is daily. This is more external range right here. The hourly, think of that as external. And then when you go down to something like the 5 or the 15 minute, this is now my external range because realistically, you're not placing trades on the 1 hour. So this is a form of internal range and this is external range. But think of this more as daily range because it's the daily high and low. Or not like the current day, but the most notable recent one. I like to look at maybe the last 3 or 4 days. That's it. Like if price is doing this, like let's say we're right here, and these are the last 3, I would probably look at this high and this low right here.
Yeah.
And maybe even this open right, or this close right here. Just because you never know, but this high and low right here is probably what I'd look at because it's more notable to me. It's hard to explain. Let me know if I'm losing you, but this is kind of one thing. Then you look at the 1 hour. So remember, daily range right here. That's how you find your daily range. You find your hourly range, also known as this is what I like to call your external range. Then you go to something like the 15 minute. I don't even mark out highs and lows on the 15 minute anymore. Maybe if you want, but this looks very noisy to me. So I'm not really worried about any of these highs or lows. I'm more worried about just like, I kind of look at this. I look at the 15 minute as more of narrative. So this is the best way how I could look at the story the market's trying to tell me. The story that the market's currently telling me is that we took this high. And in my mind, this isn't a strong closure above. Why? Because we go on the hourly. We came up. This is really what it looks like. We had a weak closure above. This is why you can't get tunnel vision and just look at something like the 5 or 15. Because this right here, oh shit, this looks notable as fuck, dude. Holy shit, we're going to go way up here. That's what you're thinking, right? When this is happening.
Yeah.
Hindsight's 20/20, but still. But you go on something like the hourly, if this is the high, we on the hourly, don't think tick value anymore. Like, I'm not talking ticks. Like, that's 84 ticks. That's enough to, like, be a good trade and stuff, but I wouldn't trade that, A. But B, on the hourly, 84 ticks is nothing. On the hourly, this is nothing. That's why you need to kind of zoom out sometimes and go on the 1 hour of the daily again. I like to go on the 1 hour if I'm unsure. If the 15 minute or the 5 minute is looking noisy, dude, go to the 1 hour. I'm not kidding. It'll be crystal clear. Don't place a trade if you don't know where the market's going. If you don't feel like you have some sort of bias, you can't know where it's going, but where if you kind of what you're looking for. You know what I'm saying? Yeah. So anyways, this could have been my internal range. We took out this internal range, but now we're trading back down. But at the end of the day, in my mind, this isn't a bullish market structure shift because this is such a weak closure. And then this is a long wick right here. This is called a turtle soup. This right here is just a form of turtle soup, which is kind of what I was saying, where you just kind of a turtle soup, it just quickly grabs liquidity and leaves. A market structure shift would be something more like this. This.
Yeah.
Maybe. This I could see maybe being a market structure shift. We might come down. We might completely fill this fair value gap. We might even take out some more external range right here, but I believe we could trade up. We could go down too. Like at the end of the day, I have friends who don't know anything about stocks, don't know anything about trading, don't know anything about shit, and they literally hit me up and they're like, "Hey man, what do you think about the market today, man?" And I'm like, "I don't give a shit." Like, that's just the truth. I'm not gonna sit here. What do you think's gonna happen tomorrow? What do you think? Trump's tariffs and everything. I don't give a fuck. Like, I'll do what the market tells me. The only reason I care about news is because in our server, but I don't know if you've seen it, we have a news channel. We post news, and we know where red folder news is. We just need to know what time that's happening because we just want to expect volatility. We don't know if news is going to go up or down, and we don't anticipate it. We trade what the market tells us. That's what day traders do. Stock traders, maybe not so much. They might more focus because they actually care about the company they're trading and they care about it. This, we're just trying to make a quick buck. We don't give a fuck how NQ is performing. We make money going down and up. So at the end of the day, this isn't notable to me. But this high right here, I could see this being a major form of liquidity because if price comes back up, think about what people would be thinking. When you look at liquidity, I want you to don't think of what you think. I want you to think of what would a panicky New York retail trader do? Like someone who doesn't know shit about trading, or maybe they think they know about trading or whatever, right? Or maybe even a past version of myself. Like, what would someone think if price came up and took this high? They would think, oh, bullish market structure shit, bullish market structure. But they thought the same thing with this, and they were too impatient. They didn't see that it actually fucking rejected almost instantly and then started trading down again. And then held below and formed a lower high. This is a high. Like, as far as I know you were asking about identifying highs, this is a high. This is a low. Yeah, but, like, just because price wicked here, I'm not going to be like, oh, okay, cool, turtle soup. And then it rejects. Because it could reject initially, but that, like, in my mind, that's the same as trading, like, a fair value gap. Like, if price came here and then created a fair value gap right here, I'm, like, I'm going long anticipating that it's going to fill this, but it doesn't always fill it. That's why fair value gaps are created in the first place. So, biggest point here, daily range, internal or external range liquidity, and then go down to the 15-minute. I like to just look at it for narrative. What the market is telling me, like I said, is we have a weak closure above. On the 15-minute, it doesn't look that way, but on the 1 hour, the 1 hour doesn't lie to you. The high time frame doesn't lie. So, it came up. We had a very weak closure above. And we tanked immediately afterwards. That's called respect. It's respecting it, and it's rejecting off of it. Then we formed a lower high, but then we had a higher low. This is manipulation, by the way. We came back, failed to take this high, which is, mind you, that's not the first, but the second time we failed to take this high. This is the third time we failed to take this high. This is the fourth time we failed to take this high. Okay?
Yeah.
This right here is this is manipulated. This bottom part right here is completely manipulated. We had a low here. Why the fuck does it do that? We had a low here. A higher low, a lower low, a lower low, a higher low. It's super confusing. Why? Because the people who got in short right here don't give a fuck if this is creating higher lows or not. Institutional traders entered short here or somewhere around here. They got in.
Yeah.
Their stop's probably somewhere right above it, close to it, and they're trying to ride it all the way down to this daily low to take it out because they think NASDAQ, they're more swing traders in a lot of senses. But they're taking that money because they aren't panicking. Retail traders are going to panic at something like this, but just my point is that is what an example of what narrative looks like. This right here is narrative. This is a bearish narrative. Not just because it's going down, but because we're having lower highs consistently created on the major swing highs. Lower highs consistently created. This would be more internal swing highs. This isn't like major to me. But all of these, they're highs. I'm not marking them out. I don't care if price takes them. I'm only looking for narrative-wise what I'm recently looking at. So what I can anticipate if I'm still bearish, and I'm looking for a bearish entry, I'm anticipating price to come up, fail to take this high, maybe take it and wick it, but fail to take this high ultimately because this is now my internal range high. Yep. Okay, because look on the 5-minute. This would be a good internal or external range high. I'm sorry, internal range high. This not so much. It's just kind of a big wick candle. This right here actually had a good strong move. It held it for a minute, tanked, came back up, tanked. This right here is more of a more notable one to me. So, like in saying that, like I said. What I would want to see is price to come up. I don't give a fuck if it takes this high. It could even take this high. It could even take this high. But my point is, it's more likely to do a reversal once it takes external. But you'd want to consider your bias in this, in the sense that if you're bearish on the daily bias, you don't want to marry your bias like, I'm bearish, so I'm only looking for shorts. Like, that's why I say if I'm bearish, because if I'm bearish, like I wrote in my journal today, for my trading, I would highly recommend you write down all of your thoughts on your trading journal. I put, let's see here. If I'm bullish, I want to see a close above. There's a 1 hour IFEG and volume imbalance, and then I said, I can't find the if I'm bearish, but long story short, you want to think if I'm bullish and I'm like want to take a long, what I would probably want to see is price come down, take this low because you want to see manipulation before distribution, then it come up and trade above all of this. But in order to do that, price has to take out this right here.
Yeah.
So it would take this internal and then go all the way to external. Does that make sense? It took out internal range. This is internal range liquidity. Holy shit. I'm clicking this. There we go. This right here is internal range liquidity. This right here. This is external range liquidity. If you can identify internal and external, you're already doing better than most traders. Like, I'm not even fucking kidding you.
Yeah.
You have any questions about that? I've been yapping. I wanna hear what you have to say now.
So, do you just mark out the internal and external on the daily to start with?
So I mark out the daily high and low, which is my daily range.
Yeah, daily range, and then hourly.
Yeah, so like these, I don't give a fuck about.
Yeah.
I'll redo it for you.
Yeah, right.
I'll redo it. You. So I look on the daily, right? We'll look at a new example. How about that?
Yeah, right, yeah.
We'll look at a new example. I'll just pick a random spot. It doesn't really matter. I just want to pick something that's a little more probable. Okay, so maybe something like this. Okay.
Yeah.
You want to kind of look at it. I'm not really marking it out, but this would be another thing to mark out right here. I usually don't recommend zooming back this far on the daily, but you got to understand, like, especially when we're taking lows and shit, you need to look back and see, like, why price traded that low. You need to know why. So price came up and failed to take this initially. This is major liquidity right here. If price failed to take it, I'm willing to bet you there's a lot of people trying to go long to take this high at this time, meaning there's a lot of resting orders and there's probably a lot of take profits right there. Okay? This would be the daily. So daily high, daily low, and then this right here I would consider because we're so close to it. And like I said, like let's say this is the day, so this is the last candle we saw. This is just opening. I want to see this or this taken out, or maybe this taken out because this is also a form of major liquidity. I'm not looking to see this low or this low or this low. I don't really care. Okay? I'm looking at this low, this high, so usually the most recent big range, and then only this because it's close. I go to the 4 hour just to look. I would see, because I personally don't only trade this, but I highly recommend you trade the 9:50 to 10:10 Central Standard Time if you're trading New York macro, because that's going to be. Let's see here. That's going to be the close of this candle and the open of this candle. So you'll see something happen here. So what this would tell me, I wouldn't see this, but I would want, because right now it's not doing. I would see the last couple 4 hour segments, 4 hour candles. Price isn't doing a whole lot of shit. So I'm looking to see what internal range or what internal liquidity we're going to take before we take external range liquidity. I hate how it resets. Hang on. So look. I would know, right, that you're not really thinking necessarily about internal range too much and what internal range unless there's anything significant, which there isn't. This is just kind of going straight down, rebalancing, going back down. This could be technically an order block right here. An hourly order block. But I'm not really worried about that. I just want you to worry about the ranges.
Yeah.
So this high, this low, and this high. This is your external or your daily range. Your external range, also known as your hourly range, would probably be something around the same thing. And if the candle's if it's, what time would it be?
Wait, did you say externals hourly? Hourly, yeah.
Yeah. Not always, but in most examples, yeah. So then
Yeah.
right here, this would be the last hourly candle, and I'm seeing bullish. You should expect one of two things during the macro times, and I'm going to warn you. You should either expect manipulation or continuation. So this is manipulation because it came up, failed to take this high, and then dipped and took, look, what? The daily external range. Daily range is a form of external range. Does that make sense?
Yeah.
Daily range, yeah. Daily range is a form of external range. It's just more zoomed out, so sometimes you might want to consider notable highs and lows on the daily. For instance, look right here. I just noticed this. Why do you think price had such a strong reaction to this low right here?
Well, let me just see when.
See that?
To be honest, I don't know.
That's okay. You don't have to. I'm gonna help you understand it. Okay. Price came up very violently here. It displaced, right? Very violently. A lot of people were trying to go long to ride that wave up. They might have gotten here. They might have gotten here. They might have gotten right here. This right here, whenever it's right before a move, it's called an order block. You don't need to worry about exactly where that order block is, but just remember an order block is a move up before a move down or a move down right before a move up. So this is the last up close candle before a bunch of down close candles. That's an order block. And this is the last down close candle right before a bunch of up close candle. So right here there's going to be resting orders, let alone this liquidity right here. Don't worry about order blocks right now too much. I'm just kind of explaining to you that you need to understand. You don't need to understand where. The problem is I focused too much when I was learning on like where exactly am I trying to look for this shit at, right? I'm not so much worried about where price is going to go exactly to the tick. I don't really care about that. I'm looking in general, what is price going to respect, right? So price came and took this low because in my mind, you have to think before you see all this shit, this violent move up, a lot of people are trying to get in long to ride this move up because they see it. So every time we have a violent move up, or a violent move down, people are always going to try to join that and ride that wave up or down. They're not trying to anticipate a reversal. And if they are, they're probably losing too. Like you can still be wrong even if you have either bias. The problem is it's time and price in the market and how price is reacting. Price took this low right here, this internal range low, because this is the daily and external. This is also external. It's on the hourly, but it's internal in when talking in respect to the external range of daily, right? Of the daily range, right? Because it's inside of it, so it's internal. So it took out this. It wicked just below it, also known as a turtle soup. Like I was telling you, turtle soup is when we quickly take a low and then we don't close. The candle does not close below it or above it. Okay.
Yeah.
This is another turtle soup. This right here, because this was a major high that was formed, came up, wicked it, and dipped. Does that make sense? It just wicked.
Yeah.
That's what a turtle soup is. But my point is, I want you to understand, not so much as like what exact confluence it is that is why it thought that. That kind of comes with understanding the market later. To help you understand the market in a quicker sense, you need to understand why price did what it did. So this, I'm not asking you to identify why did price consolidate here. Why did it consolidate here? Don't worry about that. I'm asking you why price moved this high. It did, and I'm going to tell you this answer, but I challenge you to look at the market and do what we call static testing, where you sit here and you look and you see why price made big moves, right? Price made a big move here, made another internal high right here. This is a major high. Made another internal range liquidity high, right? And started trading down. Because it took this low right here. But look, the more notable sense of this and what you need to know whenever it comes to actually placing a trade, it took this, that's why it came up, but then you see it drop off at turtle soup this high. It failed to take this liquidity right here. So, and then this also fails to close above this as well. So that forms a swing high, right? So what does this mean? This means that price came, it took internal here, it traded up into this a little bit more internal range liquidity, but it failed. More notably, it failed to take external range up here, and we had a violent sell-off here. I'm not saying you're going to be able to get in short right here. That's called a top tick. You're not going to be able to do that as a new trader. But my point is you can see strong sell-off. This is 4 hours of selling off. 4 1-hour candles of selling off. Right? Yeah. So I can anticipate, since it failed to take this high, if I were bearish, I would anticipate, I would see this, and I would immediately think, okay, we've manipulated higher. Most of the retail traders have probably been stopped out. Since I'm patient, I'm going to get the right entry. Because if I were impatient, I would have caught this long because I'm trading. But remember, retail traders trade external to internal. I don't always recommend trading external to internal, at least in this sense. But internal, right? It took this external, went back internal. I'm looking for entry in internal to take more external. This is the daily right here. This is the external range as far as on the hourly. This is the external range because this is the daily range, the daily low. I'm looking to take this out. That simple. And then you go down to the 15-minute. Same song and dance. Oh my gosh. I'm not going any lower than the 15-minute. I'm sorry. This is going to take forever.
Yeah.
Oh my gosh. Holy shit. Are we moving? Oh my gosh, dude. Hold on, I have an idea. There we go. Okay, this is better. I used market replay mode just to kind of make it go back, so I'd appreciate it if it would switch to the 15-minute. That'd be great. Okay, I guess it's not gonna let me. That's fucking annoying. We'll pretend this is the 15-minute. Fuck no, because I want to look at this shit on a lower time frame, bro. Okay, I'll have to use a more recent example. I'm sorry, but
no, sorry.
Hourly, I'm marking out. So I come into the market. I'm fresh in the market.
Yeah.
I'm like, okay, cool. This is my daily high. That's notable. My most notable daily high is what I should say.
Yeah.
And this is my most notable daily low. Or sorry, this. This is also this is the nearest notable daily low. And if we take this, that could be a huge external range to aim for as well. You're like, think of the daily chart as like where you're aiming your sights. Like if we were to start going, like if you were able to find a long entry because you were able to find a long entry, this is what you should be aiming for. This in the 1 hour or 4 hour. This is perfect because this is external range liquidity. Internal, probably something like this, right? Then you go down to the 15-minute. Like I said, you kind of look at what the narrative's telling you. Market's trading up again right now. Before it makes a big move, it usually takes something out. So it might take out all of this liquidity right here to trade right here, and then tank down to take out this external range, one of these two external range liquidities. Right?
Yep.
Or it might not take any eye. It might just trade down right now. You never know. And if it does, and it closes like below this, and you have strong displacement, you might be able to try to get a bearish entry if you're bearish. But sometimes you got to understand, you're not always going to be right in this. You just want to try your best to understand why the market moved. If you can answer why the market is moving in whatever manner, you will be successful. That's it. Like a professional trader who's really good and has years of experience and who's consistently profitable, what they do is they know why the market does what it does. They understand it very well. They know when the market's faking them out because they know what it's doing. They know because they're analyzing, and this is how I've discovered it. They're analyzing how retail traders are going to react. to a move. How would retail traders react to this move? They might think, oh, bullish, bullish, bullish. Well, we failed to take this high. I wouldn't say bullish until we take maybe this high or even this high. You know what I mean? But it's all relative to whatever time frame you're on. But I hope that helped.
Yeah. Where? One sec. Oh, sorry. I've literally got to go, like, right now. Is it alright if I join back in, like, 10 minutes?
I'm actually going to wrap that up right there.
Alright.